Let's get started. First and foremost, I just want to thank everyone for coming. As you all know, my name is Michael Petraka. I am the owner operator of HJP Financial Group. Today is probably one of my favorite topics where we get to do a semi-annual update on what's going on in the markets, what's going on in the economy. Uh, Without a doubt, this was one of the more eventful 6 months in my career, and probably one of the more unpredictable. With no further ado, let's go through the slides. Naturally, if anyone has any questions at the bottom of the Zoom screen, you'll see a little raise your hand. Feel free to click that and we can pause at any time. And of course, I'll leave some time at the end for any questions. Fantastic. Let's get started. So let's do a little recap of what happened with US stocks over the last 6 months. Now, this unbelievably sharp V has been our experience so far year to date. Now, I think if I took a vote or ask a poll question of everyone on this call, what caused that V, everyone would know the answer to that. And that was kind of the tariff experience that we went through in kind of the March, April time period. So just to do a little bit of a recap, the administration decided to put tariffs on arguably most of the world. And the main goal behind this is we're trying to get better trade agreements and kind of help businesses stay here and kind of improve our situation with regards to a lot of the countries. A lot of them are justified. I certainly have a lot of frustrations in, let's say, to not pick on China so much, but just their sheer processes where American companies to be able to do business in China has to partner up with a Chinese company, a lot of times divulging some company secrets. At the same time, they might rip off what we're kind of doing and then selling us back at a cheaper price and kind of, causing us to lose some manufacturing jobs, causing a lot of kind of pain and frustration for American companies. How that played out when it comes to the US stock market was rather incredible. So, right when the tariffs were announced on the so called Liberation Day, the following 2 weeks were rather incredible. Markets cratered just shy of 20%. Now, it's actually rather incredible that markets tend to stop right around that 20% mark. That's the mark where it's technically considered a bear market. Now, if I'm a betting man, there's a lot of algorithms and computer-based investment models that kind of know that and utilize that as kind of a bounce-off spot when it comes to market declines. So there's been a tremendous amount, more than there probably should if everything was just kind of random, but 20% is a pretty important mark in terms of whether something is continuing a bull market or has turned now into a bear market. Now, once we got down to that down 16, down 17, down 18, something rather unique happened that does not happen too often in this country. You have the US stock market, the US bond market, and the US dollar. So typically, we are the reserve currency of the world. We are the safety net of the world. When there's problems that are kind of playing out, a lot of times people leave risky investments such as the stock market and buy the bond market and buy the US dollar to play it safe. Now, what happened for about 3 days was the US stock market, when the US bond market, when the US dollar were all selling off. That's a sign money's leaving the country. That's a very scary sign. Now, I don't know if it was this or something else or the negotiations, but when this played out over a few days in a very big way, the administration, there was a change that took place, and there was let's say, gave out all these countries a 90-day break to hopefully nail out a deal. The stock market was like shot out of a cannon at that point. That was announced, and that day, markets shot up 8%. That's why when we're looking at this slide, you can't even see a white mark in between this little V because the lines are so close together. So it was literally like a light switch was flipped and markets were off to the races. Now, what's rather incredible is earnings projections have come down year to date. Now, you could say in terms of clarity, what we have kind of going forward for businesses, their ability to make decision, maybe it's a little bit clearer than a few months ago, but compared to the beginning of the year, a lot muddier. And there's a lot of corporations saying we got to hold off because we don't know where all these tariffs are going to land. So a lot of research and development and investments have to kind of slow down. So this is why I find it rather incredibly, the clarity has gone down, earnings projections have gone down, and yet the stock market has gone back to all-time highs. Now, I'm going to have some theories that I'm going to go over in a few slides on why I think that's playing out, but it is a rather incredible thing to have played out to the tune of going back up north of 25% just in a few weeks. Again, rather incredible. So to take a little bit of stock of where we are today, our stock market today is trading somewhere between 22 and 23 times earnings. We're going to spend a few extra moments on this today, and I'm also going to touch upon the earnings side of the equation. Now, a lot of people have heard me give this example. I'm trying to demystify the stock market. There's the earnings, and then there's the multiple. And the combination of those two things give us our price. Now, you could do this for an individual company, the overall market, a piece of rental property. It kind of works any which way. So I always give the example of my office. Let's say I rent it for 10 grand. You want to buy it from me. You're going to first do your homework. There's 200 other units in this complex. You're going to check to see what the other ones are selling for. And what you're really trying to find is what's the multiple of the rent that I have to pay. So let's say on average you find that the multiple is 15. So if my rent's 10 grand times 15 today on this garden variety, what's today? Tuesday, Wednesday. It's been a long week already. On this garden variety day of the week, you should be able to buy it from me for $150,000. Now that multiple changes with how much confidence is in the area. So we got a lot of rain yesterday. Everyone knows Fairfield can flood. So let's say it was tremendous rain and it flooded. Now no one wants to come here anymore. Maybe I'm only going to get 10 times my rent when I go to sell. An example of that is the 2008 financial crisis where stocks were trading at roughly 10 times. There was so much pain, so much fear, stocks were selling very cheap. Now the other extreme was, let's say we find out, we pick up the newspaper tomorrow, there's going to be a train station in New York City coming to Fairfield, New Jersey. Ooh, that multiple is going to go up a lot because there's a lot of confidence in the area. So think of around 2000, the technology world, the internet was new, the personal computer was new. We were off in the running for a lot of the 90s. So the multiple got crazy high, 25 times earnings. So the higher the multiple, a lot of the good news is already baked into that cake. So we're now trading at 22 times earnings. So if we're trying to think of ways the stock market can go up or down, it's one of two reasons. The earnings go up or down, or the multiples going up or down. So as we sit here today, stocks are trading at 22 times earnings. So let's look at that over time. So here's your multiple over time. Now history would say over the last, let's say 30 years, the multiple's around 17. You go on a slightly longer time horizon, might be closer to 16, call it 16, 17. So that means the multiple we're paying right now is on the expensive end. Now, just because a multiple is high, or just because it's at an expensive level, it doesn't mean it can't continue for 1 year, 3 years, 5 years. If I knew the answer of when the multiple is going to come back down, I would be a very rich person. We just can tell that we're paying a high multiple as we sit here today. Now I'm going to show you in a slide where what information should you take from that over time. So we're paying, we know, based on history, a little bit on the higher end. So when we look at that multiple over time, like I said, over any 1 year period of time, chaos. We don't know where the markets are going to be a year from now, rather impossible. So a multiple of 22, some years we've had fantastic banger years, great returns. Some years really horrible. Let's say flip a coin. But over every 5 year period, the rates of returns become in a much more narrow range. And if I were to show you another slide over 10 years, it's even more narrow on top of it. So a multiple of around 22. If I'm a betting man, for the next 5 to 10 years, US stocks probably are in the 5-6% range. Now, if we had a multiple much lower, think of where we were at the 2008 financial crisis, a multiple of 10, 11, that's where you're getting your 15 to 20% rate of return. So that doesn't mean we can't have an outlier event to the north side, but markets tend to be a little bit more range bound the longer time horizon you go with once you understand where your multiple is. And that shouldn't be too big of a surprise because, as I look at everyone on the call tonight, a lot of my clients are in the kind of very similar situations. This last 5 years, although very painful for some aspects of the kind of the US population, if you were a asset owner, if you owned real estate, if you owned stocks, your net worth has ballooned up in the last 5 years. As I do financial plans and I'm going through it with my clients, I'm like, this is great. Everything's great. Plans look good. Net worth's at all-time high. Markets are going fantastic. This is as good as it gets, believe me. So we've been very fortunate with this inflation that we've had if you owned assets. If you didn't, where a lot of people had a very justified frustration. If you didn't own stocks and you didn't own a house and you dealt with the inflation of the last 5 years, this was a very painful last 5 years. Really nothing like it in history, probably back maybe, let's say the 70s. So let's continue. So again, we're multiples are high, which means we borrowed from returns, we got them quickly, and now that means our returns going forward to be a little bit more muted for the US stock portion. Now, again, I want to go to the equation. So your multiple times your earnings gives us our price. So I said our multiple's high. So it's kind of hard for that multiple to keep pushing up to new highs. Well, so maybe the stock market's not going to go up so much because of multiples right now. Well, what do earnings look like? So right now, earnings projections for 2025 are coming in at 9%. Now, at the beginning of the year, the projections were around 14%. So earnings projections are coming down. There's a whole bunch of factors, but certainly I would say most CEOs in the Fortune 500 are going to point to the tariff situation, the unpredictable reality that we're all kind of in right now, that a lot of companies are just holding down and maybe not making as much developments as possible. Housing is also a big factor. That housing market is still unbelievably tight. In our neck of the woods, call it the Morris, Essex, Bergen, where you might typically have 5, 6 months inventory out for sale at any one time, it's now around 1 month. So no one's moving. That's a very bad thing for the economy. The reason for that, every time someone moves, think of all the transactions that are playing. Maybe you're going to renovate. Maybe you're going to buy new couches. Now we got to pay moving costs. There's a realtor cost. A lot of people make money in this transaction. The key to economy is not prices very high, it's money in motion. So when companies freeze because they don't know what the next tariff is going to look like, and people in their house freeze because they're locked in for a 3% mortgage and they don't want to get a 7% mortgage and deal with kind of bidding wars, that's money frozen. It's kept prices high, but it gums up the work of the economy. But as we sit here today, to just do a simple equation, let's say our multiple stays exactly the same, and those earnings are accurate. Earnings go up 9%. Beautiful. Then the stock market went up 9%. That's not a bad deal. So as of right now, earnings went down, but are still pretty good. And earnings projections next year, 12%, 14% for the next couple of years. That's a very nice story. So no complaints on that end. Okay. So again, just to recap, US stocks are elevated at this point. They're trading at expensive multiples. High multiples don't tend to be a problem if the economy keeps churning. The earnings keep going up. You don't tend to go into a recession if earnings are going in the right direction. So to switch gears, now if we go into the stock market a little bit more, we're breaking down into two different parts. You typically have what's called value stocks and growth stocks. So growth stocks have had a phenomenal run over the last 10, 15 years. Think of your big technology names. Those are your large growth, have done phenomenal. Value stocks, just to give an example, let's say you like one of the home improvement stores, and you think their stock should be trading at $50 a share, and it's only trading at $40 a share. You believe it has good value compared to what you believe it's worth. So value stocks, it might be a little bit more dividend payers as well. Typically, every once in a while, everyone gets their day in the sun. So markets tend to ebb and flow. So we've had a strong, long period of growth outperforming. So at this point, value is looking very cheap compared to growth. As of right now, inside the portfolios, I have a little bit more of a value tilt. It's also a little bit more of a kind of a defensive play as well. Now, this is an interesting new slide, and this I'm just going to touch upon for 1 minute. You know, what's, and this is a little lesson on psychology, or more or less, not, I don't know what a lesson, but at least a comment. Pain sticks, fear sticks. Something's nice and rosy, it tends to go in one ear and out the other. That's just kind of a little bit how we're hardwired. What I always don't want people to lose sight of is, stocks have been pretty phenomenal in the long run. Over every single meaningful period of time, 1 year, 3 year, 5 year, 10 year, 15 year, 50, 20 year, doesn't make a difference. They provided something that almost nothing else can do. Something that's inside of every single one of your portfolios is a US stock index. And that US stock index is practically free to invest in, and it's given us double digits rates of returns over, like I said, every meaningful period of time. Don't lose sight of that. That's unbelievable that we have access to something like that. And so don't let the scary stuff kind of freeze you and kind of deer in headlights. So what I like about this slide is just this quick little chart here where it's comparing a bull market and a bear market. So a bull market, just a period where the market's going up, bears where there's a 20% decline. Declines on average around down 38. That is painful. But your upside is 221% on average. So there's always two things you kind of have to think about with your money and your retirement and long-term stuff. What are the fears? One, if I run out of money. The other fear, markets going down. In all of our portfolios, we are just diversified and have market exposure. Market exposure is a little bit different than individual company exposure. So, for example, you can have a lot of money in company one, and let's say company two has a better product and company one goes bankrupt. That's a risk if you're holding individual companies. We own broad baskets of diversified portfolios. Every time markets have gone down in this country, they've gone back to all-time highs. That's a 100% of the time that's held true. So market downturns are scary. They happen every once in a while, but in the history of this country, we've always gone back to all-time high. That's the one we have to stomach. We have to realize we have to accept that one. The one we have to really be fearful of is inflation. And we're going to go through a whole bunch of slides around inflation, tariffs, our debt, and how you want to think about that. That's what we have to worry about is, do I have a big enough pool to make sure it lasts my whole life? These downturns, let's call it a year, and then we're back to making money in the stock market. So stocks in the long run make absolutely a lot of sense. And don't think of the finish line as retirement. That's like saying I'm done climbing Mount Everest at the top. You're halfway there. You're still going to be in stocks for decades. So those questions always come up to me. I'm worried the market's going to have a downturn right before I go to retire. It's either going to happen in the year before, the year after, or right in the middle. It's part of it. It's absolutely something I've already factored into the equation. Now, this is a fantastic slide. So this is kind of showing on an annual basis, the market's giving you a head fake, aka a decline, sometimes 5%, sometimes 10%, 15, 20%, whatever it may be, and where the market finished at the end of the year. So this one, I'm actually take a bow on this one a little bit. One thing I always pride myself, as markets are going haywire, can I convince the people that are freaking out to stay invested, stay calm, and stay long-term thinking? I convinced 100% of my clients that called and were freaking out and saying, this is the end of the world. We're never going to be able to trade with anyone, to stay the course. Now, don't get me wrong. I didn't know it was going to come back this quickly, but it looked really good in hindsight. But this was painful. So markets, like I said, went almost down 20%, and yet right now we're up around 5-6%. You have to stomach these really scary, painful periods of time. And you almost have to completely ignore the reason, which is kind of incredible to say. Whether it's tariffs, the administration, oil, the Middle East, Ukraine, there's always something to freak out. And especially if we haven't seen it before, everyone runs around like crazy. But what's rather incredible is you get used to it very quickly. So in April, when the Liberation Day came out and all these tariffs came on, markets freaked out, down 20%. Well, in the last week, the administration talked about a whole bunch of new tariffs at 20, 30, 40, 50%. Copper. What was I forget the other countries that were coming into play. Canada, big trading partners of ours. Markets didn't even budge. Copper market went up a little bit, but other country tariffs, markets just almost completely ignored it. It's just incredible how much has just become a part of it and kind of accepting and just rolling with it. But again, we want to stay calm because markets are going to test us, and this year was no different. Inflation. So 3 years ago, in 2022 up until 2023, we had the scariest amount of inflation we've seen in almost 50 years, kind of the 70s reality, where inflation peaked at 9-10%, and slowly but surely has come back into more acceptable ranges. Now, everyone is hyper-focused on inflation right now. Because the big question is, all right, we put all these tariffs on there. If we have a product that cost $100 and now we're slapping a 30% tariff to bring that into the country, that should increase prices. Now, we haven't seen too much of it come into a way showing up in the inflation data yet. Time will tell. I find it hard to believe it won't in the long run. But as of right now, the inflation data came out today. It did increase a little bit from the May number, still in reasonable levels. But it's one of those, and you may remember I did a brief market update when markets were going crazy. And I said, right now, it's like, and I'm going to give you a little picture Donald Trump in a tight gymnastics outfit, and he's going and he's running off into the horse, and he's jumping up in the air, and he's doing the twirls, and he's right now in the middle of the air. The question is, can he stick the landing? Did all of this tariffs and trade negotiations bear fruit? Or, oh my God, it's kind of unraveling? You or I do not know that. The Federal Reserve, Jerome Powell, does not know that. So the Federal Reserve has kept interest rates steady. They've told the public, hey, we would be cutting interest rates right now, but we don't know how this inflation is going to play out. We don't know how these tariffs are going to play out. In part because it's a little bit of a moving target. And I'll show you in a few slides where the tariff amounts have kind of moved dramatically. Dates have moved, so it's kind of hard to peg it down. But this is one where it's a saga that we're still, maybe we're in the fourth or fifth inning. But right now, inflation's in a reasonable level. Not enough for them to cut rates, not enough for increase rates, kind of in the middle there. Not a bad situation. So this brings us to our tariff slide. So this is our tariffs going back, for over 100 years. Tariffs weren't much of a tool, really specifically designed for certain industries. Let's say we don't want our steel industry to completely go away just in case we have a wartime. So it was really just selectively used in the past much more. And then Trump's original proposal back in April, humongous highest of all time tariffs put in place. Right now, we're still sitting at about half of that based on where we stand today. So if everything he said so far is enacted, we're looking at about a 15% increase. Now, I just want to spend 2 minutes on this. Now, what What I'm nervous about is when people say it, when I say a 15% increase, that doesn't mean the product we pay is going to go up 15%. I'm going to use a quick example. Let's say this calculator costs me 10 bucks. Now, say the company that creates it, let's say 50% profit margin. So out of the 10 bucks, 5% is profit and 5% is the cost to sell it. So part of the cost to sell it is the employees, some the rent, some the marketing department, some of which is, let's say, the cost to ship it here, let's say from Asia. Now, let's say out of the $10 cost they sell it for, $1 is what the actual cost is to get it here. Well, that $1, let's say, goes up 15%, and let's say we tack it on top. So something that $1, I'm sorry, the cost was done $1, now it's going to cost $1.15 because of the 15% increase because of the tariffs. So let's add that 15% to the sales price. So it was $10, now it's $10.15. That's somewhere in the 1 to 3% increase in costs. So I don't want you to think when the tariff's 20%, 40%, you think the shelves are going to show 20, 30, 40% increase in prices. It won't. Now, the concern there is, those are the tariffs one way. Well, what happens if they start putting tariffs the other way? And it could certainly have a ripple effect and amplifying effect. You kind of saw that with China early in the year. We had one tariff level, they put it on one, we increased it, they increased it, we increased it, they increased it. That is a scare that will send us in a recession real quick, hence how much markets kind of freaked out during that time period. But I just don't want you to think if there's a 15% tariffs, that means all the prices are going to go up 15%. The price of the product is one part of the whole cost of what they might sell it for. You got the devil on one shoulder and the angel on the other shoulder. This is the part that keeps me up at night the most, because it's hard to predict and you don't know when the music's going to stop. And so let me explain that a little bit. So what we're looking at here is kind of our federal balance sheet, our federal kind of budget reality. So let's walk through this a little bit. So here's our 2025 federal budget. Total spending, $7 trillion. Now we're bringing in, I'm just going to use round numbers, let's say $5 trillion. We're running close to $2 trillion deficits. All right, that deficit is a very high percentage of our GDP. So you may have heard that we're running 6-7% deficits. That's high. But it's like, to give you an example, it's like if someone had debt of $1,000 and a take-home salary of 30 grand, that's one thing. And a debt of $1,000 and was taking home $250,000, it's a very different thing. So we always want to think of debt in the context of the size of the economy. And there's been kind of ratios over time where economists and people would say, hey, you shouldn't probably go past these lines. Our debt as a percentage of our GDP, 100% is kind of one of those lines that historically you tend to start to have problems. Like I said, I'm going to give you both sides of the coin here. So let's break down our budget. Our interest, got to pay our interest. Social Security, good luck if anyone in Congress wants to touch it. Same with Medicare. Medicaid, there was cuts. Now we have to put things in context a little bit. If I showed you Medicaid spending, over time, and then let's say we're in 2019, right before COVID, and then it spiked up like crazy dealing with COVID, and now the cuts are a little bit still substantially above 2019, but everyone freaked out because of the cuts from the most recent high. No one wants to cut, and everyone gets it. When you cut, it's going to cost lives. There's no doubt about it. You always have to, but keep in mind is like we're going to have to pay for all of this at some point. I want to save everyone. I want to give everyone everything. But what happens if we overspend to the point where all these programs are gone? You have to understand, like similar to your own personal balance sheets and some of your own personal budgets. if you bring 100 grand into the household, you can't be spending 110 every single year. At some point, the people who let you borrow, the credit cards and the mortgage companies, are going to say, this is a problem. This is not sustainable. Now, we've gotten a pass for a very long time because we're the reserve currency of the world. We have a fantastic, humongous economy compared to anyone else. And there's really no other game in town. There's no other country that has our size, that has our rule of law, that has the comfortability of someone, a corporation from Europe can come here and feel like they could get a fair shake to kind of grow the business and see where it goes. But everything has limits. So we're running $2 trillion deficits with 37 trillion in the hole. You or I don't know when the music is going to stop, when the markets say we're not willing to sustain this. But we have to pay attention. And one slide I found incredible. You see the net interest payment of 952, which is pretty much at $1 trillion right now. If you went back 20 years ago, our debt payment was right around 200 billion. So we're going up fivefold in 20 years. And that was a period of time where interest rates were very low. If you think 5 years ago, you could have got a CD was paying you 1%. Same with treasury bonds. We were able to borrow very cheaply as a nation. Well, now debt is rolling off in the 1-2% camp that we have to re-up in the 4% camp. So all the interest rates much higher, it's going to really go high over the next few years. Now, it could last 10 years. It could last 100 years. You or I do not know the answer to that question. I'll put it this way. Ray Dalio ran one of the biggest hedge funds in the world, and he's going on TV right now saying this is a problem, this is not sustainable, we need to do something about it. He also said stuff similar to that 20, 30 years ago, and it's been okay since. It's just very hard. I'm not saying don't get me wrong, I'm not saying he's wrong. I'm not saying we need to ignore it, but it's hard to peg down when it really becomes a problem. The other side of that coin, call it the more positive reality in terms of prices, in terms of your guys' retirements and your house and your net worth and things like that. Also, over the last 5 years, the government printed a tremendous sum of money, trillions of dollars. My own personal opinion is why the markets came back so quickly is if you were to add up all the money in money markets, CDs, checking accounts, savings accounts, you're talking north of $20 trillion. Now, if you went back 15, 20 years ago, it was like a quarter of that. All that money is slushing around in the system trying to find a home. So every time the market goes down a little bit, so much money is waiting in the wings to buy stocks, to buy real estate, to buy gold, that everything's getting priced up to all-time highs. So it's not too much of a surprise to me that Bitcoin, gold, stocks, real estate, everything's gone up because there's so much cash trying to buy assets. That's why every time there's even a little blip, it shoots right back up. So as much as there's scary stuff over here, the odds of, I think, markets going down substantially with so much stuff is, waiting in the wings to kind of buy, I could easily see prices continuing. Now, in saying that, another way of putting that is that's going to push on inflation. Prices are going to continue to go up. What tends to do the best compared to everything else when it comes to inflation? Now, don't get me wrong, if inflation is very high, like we saw in 2022, there are no winners. Stocks are going to do poorly, companies are going to do poorly. Everything really does poorly. So that's where, governments get in a lot of trouble when inflation runs too high for too long. That's where you get kind of regime changes. So putting that type of inflation aside, just normal garden variety inflation, I think that stays a little bit higher. So you have to own things that typically do well with inflation. I always tell people, think of investments or assets into three buckets. something that loses to inflation, something that maintains with inflation, something that grows beyond inflation. I think three things really help your net worth grow faster than inflation. If you own your own business, or if you have a profession that allows for pricing power to get big increases in your pay. Let's say there's four. So big increases in your pay based on your own knowledge and skills, your own small business, rental real estate, because you're collecting rent and plus the properties are naturally appreciating, and the stock market. Those to me are the only four things that I can think of that have consistently outpaced inflation. Your middle bucket that maintains with inflation, maintains your purchasing power, I would put your primary residence. Now, everyone says it's a great investment. Yeah, over the last 5 years, it's been fantastic. But over the long run, typically you might get 1% more than inflation with your primary. But if you think of all the stuff you have to do, I just redid my sidewalk, cost me 7 grand. It's typically a good storer of wealth, not a good grower of wealth. So your primary residence, conservative bonds and CDs keep up with inflation. Cash is the biggest loser by far. And we're going to go over a slide in a few that kind of amplifies that reality. So we're touching the stock market. Now we're going to touch on the bond market and interest rates. So this is the Fed funds rate, what we're looking at right here. So just to go over recent history, we kept rates very low, and then inflation spiked after COVID. So the government had to raise interest rates at the fastest pace in history. They kept it up there a little bit and they've started to go down. Now, this is where we've kind of hit the pause button. And this is what I was mentioning before. Jerome Powell, the Fed president, said we would probably be continuing to lower right now if it weren't for the unpredictable reality of the tariffs and the trade agreements. So markets, this is kind of what you're seeing. Market projections are here in the green. Government projections are here in the blue. They do believe it'll continue to go down. But hopefully we don't see any spike of inflation because of kind of tit for tat tariffs. Now, this is not a bad thing for everyone on this call. All my clients are in their 50s, 60s, and 70s, and 80s. So what do we want? We want conservative stuff paying nice, high, healthy rates. So this is why our bonds are paying, 4.5 to 5.5%. That's fantastic. So, if you were getting a mortgage, you want low rates. If you're a saver because you're now in retirement, we want a little bit higher rates, or at least we'll call it healthy. High, not so much. But 4, 5, 5.5, that's fantastic. We'll sit there all day long because especially times like this, where every single person that I've spoken to, I've said, hey, we're rebalancing and taking a little risk off the table because stocks are high, your net worth is high, your financial plan looks great. We have a winning hand. Let's take some risk off the table. And how wonderful is this? We get to go buy stuff and kind of, let's say, sit on the side and collect nice, high, healthy rates, as opposed to 10 years ago where CDs were paying 1 and bonds were paying 2. So this isn't a bad thing. Markets on the interest rate rise, like I said, has kind of hit the pause button for a few months. Now, this is what I was just talking about before. When it comes to bonds and your primary residence, yeah, you might make a return, but you have to think of return after inflation. So what you're looking at here is kind of the 10-year government bond or a 10-year treasury. And what I'm just trying to show you is this spread. So we have the nominal yields. That's what the yields, let's say the quoted yield. So right now on June 30th, you could put a 10-year government bond and paid you 4.25. Now we also have to realize inflation is a thing. So the cost of goods over the last year, we'll say is 2.77%. That means we netted 1.47. So whenever we're thinking about rates of returns, it's rates of returns after inflation. That's why, like, when people say, "Oh, I'm going to go get a 4% CD," well, if inflation is 3%, you're maintaining your purchasing power. That's not nothing. But we got to think of, or is this your long-term money? Is this the money you might need in the next year or two? You want to certainly put it in the right category based on your time horizon. Now, switching gears. So we talked about a little bit of value versus growth stocks. We talked about the multiple we're paying. Now we're talking a little bit more about international stocks for US stocks. So these things tend to go through cycles. As I was mentioning before, value and growth kind of goes back and forth. Every once in a while, each has their day in the sun. Same thing between international and domestic. Now, this just goes back to the 90s, but in the 80s, international stocks did substantially better than us. The US in the 90s, substantially better than international stocks. 2000, 2010, international did better. Since the kind of the bottom of the crisis, financial crisis, we've had a long, beautiful run of US stocks outperformance. So US stocks right now are trading at 22 times earnings. International is closer to about 14 times earnings. They're a lot cheaper. Our US dividends are paying us 1% in chains. International dividends are about double that. You're probably looking at a period where international is going to do a little bit better. Year to date, US stocks are up, like I said, 5, 6%. International is up around double to triple that, depending on the country. Who knows if that's sustainable? That's a big question. So we've had a rather unbelievable ride for our large growth tech names. We'll see if it continues. Things tend to regress back to a mean. But, to give you an analogy is maybe some of these big tech names have kind of created a moat around themselves. Perfect example was Canada was going to put a tax on all of these big tech companies. And the US administration said, that's no go. So if you do that, the trade negotiations are done. And they said, oh, okay, we'll back off. That's incredible for corporations to have this protection around them. So maybe their run can continue. Um, one of the things I always want, I couldn't care less. I couldn't care less if US stocks win, international stocks wins, the bond market wins. It makes no difference to me. You can't have favoritism. Like I don't have, it's not about being patriotic that I want US stocks to win. Yeah, I hope they do. It's great. But in terms of when I'm managing people's money, it's just based on the design, what makes sense over time in terms of where we're putting what investments. So some of you might be familiar with this slide. This is just kind of all the different main types of markets over time. So let's just kind of walk through a little bit. So this right here is showing you rates of returns from 2010 through the end of 2024. So in a solid 15-year period. And you can kind of look on every year, what did the best, what did the worst, what was kind of in the middle. So we have large cap stocks did fantastic. You all know that big household names in the US have just done phenomenal. Small caps have done all right, around 10%. Real estate, 9%. This is asset allocation, so called a diversified approach, a little bit of everything here. High yield bonds paid you about 5.9. Emerging developed markets, equities, think of Europe and Japan, did about 5.7. Emerging market, Asia, South America, Africa, about 3%. That's not a great rate of return over the last 15 years. And then we have the bond markets that have done kind of poorly because you may remember CDs and interest rates were much lower. So you practically got nothing on cash, 1%. Commodities have had a brutal 15-year stretch. But again, if you were in a diversified portfolio, you did okay. When I do financial plans for everyone, I typically use about a 5% rate of return. Nothing crazy, nothing over the top. Now, we're say, is that a good rate of return over the next 10 years? Well, I'm going to just give you my opinion of what I think plays out over the next 10, 15 years. Large cap US stocks are probably going to regress back to the mean. Kind of, if they had outperformed for a big period of time, they'll probably underperform a little bit for a big period of time. So instead of the 14%, maybe we're at 5, 6% for US large stocks. Probably for the same for small caps. So let's say 5, 6% for these two. Real estate, probably about the same. High yield, if you look at what the starting yield is, or how much interest we're collecting on those bonds, which again are around 6%, that probably does about the same. Developed market international, where they gave us about a 5% rate of return because they're trading so cheaply compared to US, they're probably going to give us that 8 to 12% rate of return. Same with emerging markets. And then in bonds, which is fantastic for everyone on this call, bonds are a big part of your portfolios, are probably going to give us double what they have over the last 15 years. So I still think rates of returns will be right around where the asset allocation is here, but we're just going to get it from a different part of the market. Hence why the overarching theme, everything has its day of the sun. Just because something's worked for 10 years doesn't mean it just goes on indefinitely. That has never been true. Again, we don't want to put all our eggs in one basket. For those of you that, the last 6 months have caused you a little bit of anxiety, always remember everyone on this call tonight is in some sort of mix of stocks to bonds. So let's say roughly 60-40, 60% stocks, 40% bonds. Since 1950, that's provided a nice high rate of return. Like I just mentioned, I don't think it's going to be as high as 9%. I think it's going to be 5-6%, somewhere in that ballpark. But more importantly, what you need to factor in is, yes, any 1 year can be scary, but for every 5-year rolling period, if you have some mix of stocks and bonds, like I said, a 60-40 mix, you see, that portfolio's never had a 5-year down period in the last 75 years. We've had some crazy, scary, horrible stuff play out. As long as you stay disciplined, stay calm, you're going to be fine. Now, the other thing to keep into mind is that's part of the reason we're also diversified. So let's say you're in retirement and we're distributing money. Yeah, I understand you're looking at your total net worth or total account size go up and down, but that's not how we're distributing money out of the account. For example, let's say this was March or April this year. So US stocks have gotten killed. Well, international stocks did well. Gold, which is within our fund, made one of the funds in our portfolio did very well. The bond market did well. We're only touching 4, 5, 6% of your portfolio. So as long as something out of the 6 or 7 funds we're in, or 6 or 7 different types of investments we're in, is doing okay, which the majority of time there's always something that's doing okay, we're going to be fine. As long as we don't just have to touch that one that's going through its bumpy period, we're going to be in good shape. So again, we always want to be disciplined long-term investors. Now, this is what I was touching upon earlier. So this is roughly over the last 30 years. So if we went back 30 years ago and you could say, I could buy small company stocks, large company stocks, the bond market, or cash, what is my rate of return after inflation? So if I put $10,000 and I just left it in the bank, it can buy you about $9,200 worth of goods today. That is not going to cut it in the long run. Cash is great for 1 year, the next 2 years, fair enough. But beyond having that, I don't recommend it. Your kind of your long-term pool of money in cash. Bonds have done okay, like I said. You might do a smidge better than inflation. But as I mentioned before, stocks have just been an unbelievable source of getting a return above inflation in the long run. And if you don't want to be a business owner and you don't want to be a landlord, and you're in retirement, I don't know too many places you can go to get that good, healthy rate of return that's going to keep up with inflation in the long run. So in saying that, I hope everyone got some value out of the presentation, and I'm going to pause here to see if anyone has any questions. No one ever does, but that's okay. You always have access to my phone number, my email. If you want to have a little bit more of a one-on-one dialogue about some of the stuff or how any of the slides I said pertains to your own personal situation, always feel free to reach out. I thank you so much for joining. It truly is a pleasure. I do enjoy doing these, so thank you for listening, and I hope everyone has a wonderful night.